Nicolas Cage has starred in over 100 films. He's won an Academy Award. At his peak, he was one of the highest-paid actors on the planet, pulling in $40 million in a single year. But here's the part Hollywood doesn't talk about. By 2009, the IRS had placed tax liens totaling over $6 million on his properties. He was being sued by his own business manager. He owed so much money that he had to sell off properties at a loss just to stay afloat. So what happened? How does someone go from earning $150 million to financial ruin? Today, we're breaking it all down, not to make fun of Nicolas Cage, but because his story contains some of the most important financial lessons you'll ever hear. Lessons that apply whether you make $30,000 a year or $30 million. Let's get into it. To understand how Nicolas Cage lost everything, you first have to understand how much he had. During the 1990s and early 2000s, Cage was on an absolute tear. Films like Con Air, The Rock, Face/Off, and National Treasure turned him into a global box office machine. He wasn't just acting, he was a brand. And the money? It was flowing. Between 1996 and 2011, Nicolas Cage reportedly earned somewhere between $150 and $200 million in total income. By most people's standards, that kind of money should be generational wealth. The kind of money where you never have to work again. The kind of money where your grandchildren's grandchildren are still comfortable. But Nicolas Cage had other plans. Let's talk about what he actually spent his money on. And I want you to pay attention here, because what you're about to hear isn't just wild celebrity behavior. It's a masterclass in what financial psychologists call emotional spending. First, real estate. Nicolas Cage didn't just buy houses. He bought castles. Literally. He purchased Schloss Niedstein, a medieval castle in Germany. He also owned a Bavarian castle called Waldeck. At one point, he owned 15 properties across the globe, including a house in Rhode Island, a compound in Las Vegas, and multiple homes in Los Angeles. Some of these properties were reportedly haunted. And yes, he sought them out specifically because of that. Then there were the islands. He purchased a private island in the Bahamas for $3 million, and another one in a different location. The cars, over 50 exotic vehicles, including rare Ferraris and a Lamborghini Miura worth more than $450,000. The yachts, the private jets, the art collection, and then, and this is the one that gets me every time, the dinosaur skull. Nicolas Cage once outbid Leonardo DiCaprio at auction for a Tarbosaurus skull. He paid $276,000 for it. He later had to return it because it had been illegally smuggled out of Mongolia. So to recap, we have haunted castles, private islands, 50-plus exotic cars, and a stolen dinosaur skull. This isn't just eccentric behavior. This is a complete absence of a financial system. By 2009, it all started to unravel. And the speed of the unraveling was just as shocking as the spending. Here's what happened, step by step. First, the tax liabilities. Cage owed the IRS millions. Reports at the time suggested he had failed to pay taxes on multiple years of income, resulting in liens on multiple properties. When you earn at that level and don't proactively manage your tax burden, the government doesn't forget. Second, the liquidity trap. Most of Nicolas Cage's wealth was tied up in hard assets, real estate, physical collectibles, cars. None of that is liquid. When you need cash quickly and all your money is sitting in a Bavarian castle, you have a serious problem. You're forced to sell at a loss, often below market value, just to generate liquidity. Third, the lawsuits. Cage filed a lawsuit against his business manager, Samuel Levin, claiming negligent financial advice. Levin countersued, alleging that Cage had ignored warnings and spent recklessly. What followed was a very public legal battle that revealed just how dysfunctional the financial management Cage had been on most of his properties, often at steep losses. The Rhode Island mansion, the Bavarian castles, the Bahamian island, all gone. He reportedly had to take acting jobs specifically to pay off debts, which is a surreal situation for someone who had earned $150 million. Lesson. So what can we actually learn from this? 3 major lessons. And these apply to you, regardless of how much you earn. Lesson 1. Emotional spending is a wealth destroyer. Nicolas Cage didn't buy haunted castles because he needed them. He bought them because he wanted them. Impulsively, emotionally, without a structured financial framework. Research in behavioral finance consistently shows that high-income earners are just as susceptible to impulsive spending as everyone else. The amounts are just larger. Without a clear investment policy or spending framework, every purchase becomes an emotional decision. The fix? A spending plan, not just a budget, but a framework that requires a waiting period and objective review before any large purchase. Some financial advisors call it a 72-hour rule. Others require approval from a financial counsel. The exact system matters less than having one. Lesson 2. Asset diversification is non-negotiable. At his peak, the vast majority of Nicolas Cage's wealth was concentrated in a liquid, non-income-generating assets. Castles and dinosaur skulls don't pay dividends. They don't generate rent. They don't compound. A properly diversified portfolio across liquid investments, income-generating real estate, equities, and cash reserves creates resilience. If one asset class underperforms, others cushion the blow. Cage had no such cushion. The fix? Work with a fiduciary advisor to ensure your portfolio is structured around both growth and liquidity. The general rule of thumb: keep at least 3 to 6 months of expenses in liquid assets, and ensure your long-term wealth is generating returns rather than just sitting idle. Lesson 3. Tax planning is wealth preservation. This one is critical, and it's the mistake most people make when their income jumps significantly. When you're earning millions of dollars, your tax liability doesn't just grow linearly, it scales dramatically. Proactive tax planning, through legal structures like LLCs, trusts, tax-advantaged accounts, and strategic timing of income, can legally and significantly reduce what you owe. Reactive tax management, which is what Cage appeared to have, means the IRS comes knocking with years of back taxes, penalties, and interest. The fix? A CPA or tax strategist who specializes in your income bracket, working in tandem with a financial planner. Not someone who just files your return, someone who actively plans your tax position throughout the year. Nicolas Cage's story isn't really about Nicolas Cage. It's about what happens when extraordinary income meets ordinary financial habits. Most of us will never earn $150 million, but all of us will face moments where our emotions want to make financial decisions. Moments where a shiny purchase feels more real than a retirement account. Moments where paying taxes feels optional. The difference between building wealth and destroying it often comes down to one thing: having a system, and having people in your corner who will tell you the truth when your emotions are making the decisions. Nicolas Cage is still working, by the way. He's been incredibly prolific in the last decade, and by all accounts, he's rebuilt a significant portion of his finances. That part of the story is worth remembering too. It's never too late to build better financial habits. But the best time to start? Before you need to. If you found this video helpful, subscribe. We break down real-world financial stories like this every week. And drop a comment below. What's the biggest financial lesson this story taught you? I read every single one. I'll see you in the next one.